Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 15th of August. I'm Daniel Lam, your host for the podcast. Before the US CPI released last night, the S&P 500 index options market were pricing in more than a 1% move. However, in reality, the actual moves were muted compared to expectations, with the index up 38 basis points, and VIX, the short-term volatility indicator, falling to 16%, the lowest level since the sharp sell-off at the start of the month. The release made a Fed rate cut in September, almost a base case in capital letters. Headline and core CPI eased for the fourth consecutive month in July, taking down 10 basis points to 2.9% and 3.2% year-on-year, respectively. Some of the details are worth mentioning. There was a large 2.3% monthly drop in used vehicle prices, driving the overall decline of the CPI, but further decreases of this magnitude are unlikely to be sustained. Meanwhile, super core inflation, i.e. core services ex-shelter, re-accelerated, and shelter inflation also grew 40 basis points month on month. But these dynamics is not likely to derail the disinflationary trend in the US economy. The fall in vehicle prices foreshadows declines in auto insurance prices, which have thus far remained resilient. Moreover, a deteriorating labor market will continue to promote demand-driven disinflation. The jobs market is going to be the focal point of macro watchers over the next few weeks before the September FOMC. It is likely to determine the magnitude of the rate cut. Now, a weaker than expected number could increase the chances of a 50 basis point rate cut instead of a 25 basis point one. What does all this mean for risky assets? Well, with the lack of key macro trigger points, the risk of the sharp sell-off from last week repeating looks to be fading. We continue to advocate investors to be scaling in for the US growth stocks. For Nasdaq 100, that means accumulating between the current level just above 19,000 and the double bottom support level at 18,000. In terms of bonds, it makes sense to lock in the longer-term yields, as yields typically trend down in the Fed's rate cut cycle. 4% for the US 10-year Treasury yield is a sensible level for investors to be buying bonds. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.